Oh, I have a narrative to add. So someone
You want
a while
to draw
ago,
a graph?
no,
Oh,
no, no,
don't
not a
need a
graph.
graph. Okay.
So,
Welcome back, everybody, to episode 5 of the Backholder Pod. Today with me, it's the same old people, Kelvin, Bunti, Eric, and Chiking. So this time around, I think for this week specifically, we have a few interesting topics. And also, just to give you guys a precursor, we are going to film 2 episodes on the same day. So for next week's episode, it will be fairly interesting. I think the topic will be around somebody that is pretty controversial on the YouTube space. And also apologies that I think we do have some mismatch in schedule because it's the December holidays, people are traveling. So we will try to concise it into maybe 2 shorter episodes, and we'll play the second one next week to kind of fill up the gap. So I think just to kickstart the conversation or to update anyone, has anyone made any portfolio changes in the last 3 to 5 days?
I bought some Microsoft yesterday during the dip.
Wow.
But Microsoft didn't dip much, right? It's just like $2,000 dump in.
So that's some lah. Okay. Now we get an estimate of $2,000.
Oh
okay.
Yeah, then last week I was telling you guys that I sold some Tesla call options. And it was very near in the money. So Tesla dropped back down. So now my options are safe all over again. So it's
Okay.
good money.
So you didn't roll anything, or you didn't add new positions, right?
I just closed for now. I will only add. I will only sell calls on green days because it will worth a lot more. So
Okay.
yesterday was a red day. I didn't do anything. I just closed it.
Understand. So if you guys are interested in what Kelvin is doing on a weekly basis, remember to smash the like button, and honestly help us just click subscribe on the way down as well, because we tend to get quite a lot of views, but our subscribers are quite sad. So that's a public service announcement. So I think just to transit over to the first topic that we wanted to discuss. So there was this very interesting development, I think, over the last 1 week or so, where BlackStone, which is one of the biggest fund management out there, I think they kind of deal with a lot of the institutional investors and their REITs portfolio. So for those of you who don't know, REITs are real estate investment trusts. So their REITs portfolio is experiencing some sort of challenging times now. So maybe I'll pass the time over to Bunti to maybe just give us a quick summary, and then we can go around the table to discuss what are the broader implications.
Yeah, thanks, Chiking. I think in this case, right, this is not normal REITs that we all invest in. It's not really for retail. This is for institutional investor. And the REITs is not a listed one, meaning that these are the funds that is collected by all these like private equity investors like BlackStone. So they take the money and they invest in real estate. So what happened is that if we just look at their contracts, they can allow the investor to cash out, but there's a percentage that they allow for, say, for example, if it exceeds certain percentage and they don't have liquid money to allow their customer to cash out, they will just say, okay, let's stop it here and you cannot cash out your money. So I think that's roughly what's going on here. I think maybe Chicken, you can add further also.
I think there is also a difference between there was this idea, at least on the online space, they were conflating this as a bank run. So they were saying, oh, if your portfolio is legitimate or if it's real, why are you stopping people from cashing out? I think there is a bit of nuance here. So firstly, I think, as we know, real estate is a lot more illiquid. So when at a very short period of time, suddenly a lot of people wants to cash out, right? It means that they might be forced to sell their position. So if you look at it from a mutual fund or ETF perspective, they can, because stocks are very liquid assets. But in the real estate business, I think it's a lot more illiquid, and they need time to kind of find the perfect buyer, or don't need to be the perfect, but they try to sell at least close to market price. I think that's one part. And I think the second part I also wanted to comment was this idea where I was watching a video from Patrick Ball. So he's actually a hedge fund manager, he's a professor, blah, blah, blah. Yeah, his credentials is pretty tokong one. But anyway, I think he was also saying that because it's a REITs portfolio and it's a private REITs portfolio, right? The valuations are not made known to the public. So it's unlike your Parkway REIT or I don't know what other REITs, first REIT in Singapore market, because it's traded on an exchange. So based on how BlackStone recognizes their asset value and how whatever they use to value, right? They tend to try to find their own in-house or outside valuers to come in and say that, hey, your portfolio is worth X amount of money. So there was this interesting comparison where if you look at REITs, but the overall REITs market, I think it's down around 20 to 25% this year in the broader index. But interestingly enough, BlackStone's REITs portfolio was actually trading flat, or at least there was not much movement. So many people also speculating that, hey, is it something like a FTT token where they own self call the name of the valuations of their portfolio? So that was also one of the interesting discussion points that I saw online. So maybe just wanted to ask whether Eric or Kelvin, are you guys concerned when you see that institutional investors are currently kind of moving out and trying to quote unquote cash out their positions?
But I think REITs, I mean, real estate market is actually not doing well other than Singapore. Singapore is doing very well. But other than that, I guess they are just trying to, investors are just trying to cut their losses, I guess, like before the crash continues any further. Yeah, I don't have too much insight on this What does Eric think?
Actually, I have a question. Like, it's more local than the US side, because just now you were talking about our local property is doing great and all that, right? It's really doing very, 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 very well. If I look at the screen, I was just checking the Parkway Life REIT, right? They are doing, the dividend yield is only like 3.12%. I don't know whether it's the info like super zun to the day, but it's 3.12%. SSB T-bills is like easily can win it. And this is a REIT. This is a REIT. The dividend comes with risk, market risk. So what are we really saying here in Singapore is we don't care about all the Fed. I don't care about all these things. We just want to get that 3.12%, which is lower than SSB. And I'm glad to take on that market risk as well. That sounds pretty illogical to me. So that's my question to you guys. Like, do you think REITs like Parkway Life is valued properly? Like, is investors like so anchored on the past valuation? Because last time I think there's a rationale, because our SSB and bank interest, all that cannot make it It's like very, very low. Then so Parkway give 3%, okay I mean, even less than 3%, they will take it because no better option, right? But now there's so many options, short-term, long-term, all have. Then why are we buying this Parkway Life? Like, I don't really understand. Like, you guys have any insights?
Yeah, I think for Parkway Life REITs or any publicly listed REITs, I don't have any insights into this. I don't look into very details, but at least we can be assured that these are the REITs that is publicly listed and publicly traded. So anyone who can access the stock market, they can actually buy and sell. So at least we can be assured that the pricing reflect a lot of information in the market, because if the price doesn't make sense, right? Let's say it's too high, then there will be people who sell the REITs to take advantage on that, and vice versa. But come back to the BlackStone, is totally different situations. That one is a funds that is having all these unlisted REITs. These are physical properties that they are holding. So whatever money that all the investors cash out, they actually cash out at the net asset value, or the NAV. And that NAV is not something that is heavily traded. This is based on valuation, based on appraisal. So there's some subjective valuations involved in there. So what happened is that, like what Chicken just mentioned, they reported a very good performance numbers relative to the rest of the REITs, especially those publicly listed REITs. So what happened is that the NAV doesn't reflect the real situations on the market, because everyone dropped by 20 to 30%. If we do real revaluations on this BlackStone fund, right, by right, their performance also should drop similar level, but it's not the case because they just kind of like using some valuation and try to justify that, oh, actually their value is still intact. But what happens is that if they forced to sell, they can't actually sell it at the value that is consistent with what is being reported in their NAV. So basically, it will become a fire sale if they have to do it. But good thing is that the contract actually protect them from doing so, because they don't have the obligations to sell it. So they can just say, okay, investor, you want to cash out? Sorry, you can't do that. So you just have to wait. So I think that's the situation. It also signals that there's actually a lot of weakness in the property market, given that now interest rate is a lot higher. I think this is quite concerning in a general macro sense, especially for the real estate asset class.
Right. Then thanks, Wunki, for the explanation on the BlackStone topic. I think also to circle back and to kind of, truth be told, I'm going to have a disclosure first. I don't really know what's exactly going on in the REITs market in Singapore, but maybe I can just provide my own perspective. So I just quickly went to Google a few of the top S REITs, right? So your CapitaLand, Mapletree, stuff like that. So most of them actually have a dividend yield of around more than 4.5 to 5 and above. So it seems like Parkway Life here is the odd one out at only a 3% yield. So I think if you make a comparison, right, it's true that when your FDs, I think RHB is currently offering like 4.1% FD or some savings account also giving at sky high interest rates. It feels a little bit counterintuitive into why Singapore so-called dividend warriors, I would call them dividend warriors because they are hunting for this sort of REIT opportunities, right? So why are they even interested? Probably also because if you take on market risk, yes, to the downside as well, but there's also to the upside. So when I look at all these stock performances, right, most of them year to date is down like 25%, 30%. So some of them are probably punting for an increase in price if they think that interest rate is transitory. Maybe that's one possible reason. Then a second reason is I think Parkway Life specifically because it's a healthcare REIT, and I guess Singapore is a healthcare tour. I mean, we have some medical tourism or something. I learned in social studies like 10 years ago. Don't quote me on that, but from what I understand, I think at least in the C region, there is still this sort of tailwind that supports the industry. But I think for general REITs per se, it kind of trades in line. So if the FD rate is 3-4% risk-free, then dividend yield should at least be 5% for general REITs. That's why the stock price for many of these REITs have all been plummeting to essentially reflect that kind of risk. So that's just my general understanding of the REITs market thus far.
I just want to add on for Parkway Life, even though it's a Singapore REIT, most of their portfolio is in Japan. They are like nursing home stuff. All these kind of REITs are like Mapletree, Parkway Life. The incredible thing is that they are doing acquisitions every 3-4 months. So every time they acquire, their dividend goes up. Dividend per unit goes up. It's very rare that their dividend per unit will drop. So that's why it's so stable right now. And another thing is they are not so exposed to the US property market. Capital Mall is in Singapore, Mapletree is mostly in Asia, mostly in Singapore and Asia. So, and to answer Eric's question, why would people hold Parkway Life when it's giving 3% yield? Then I could say the same for Tesla. Why would anyone hold Tesla if it's giving negative 50% right now? So I think it's a long-term thing. So
right, like,
no one can.
Round one, we're gonna fight.
But also one thing I wanted to add, right? Like because of the acquisition and stuff, especially in this kind of environment, I'll be a little bit more cautious as well. Because I don't really know how long this interest rate thing is going to keep hiking. And even if the Fed stops hiking, stagnating at a relatively high interest rate is also pretty scary. If your portfolio is pretty leveraged in this sense where you are taking out money to fund acquisitions or taking out money to roll over your financing and debt and stuff. So I'm not really an expert in this segment. I don't proclaim to be as well, and I'm not very interested as well. So yeah, that's my conclusion for this part. Yeah, back to Eric. I think Eric also hold REITs, right? So are you currently concerned or are you looking for opportunities?
I'm actually looking for opportunities to add because I was looking through my portfolio like 2 days ago, right? Tabulating all the dividends from my REIT portfolio. I think it's only like about 10K this year. So I think not that great not doing that great. So trying to up it to like 20K a year from the dividends. So we'll see next quarter, right? If there's any good deed to add, because now still like there's no blood on the street, right? So I need to see some blood, preferably not my own, but blood. Then
I think if
I'll add some.
Right. If I do a back of the envelope calculation, a 10K per year REIT dividend, that's around a 250,000 exposure in REITs. So I think REITs is a small percentage of Eric's portfolio, right? So
Oh no,
that's
no,
just
it's quite big lah. It's quite big. Okay lah.
200. Okay, can. No lah, just joking. So I mean can calculate lah, but I think also moving on to REITs, right? There is also this consideration now, especially when China has been a very pressing issue recently. I think we have also discussed it for some time about the protests, about the lockdowns and supply chain and the whole laundry list of things happening in China today. So I think just last week, Apple there was this headline, I think from Business Insiders or where, saying that Apple is currently trying to move their production away from China. And more importantly, also, I think one of the most concerning stock here amongst the four of us is Tesla as well. So there is also this recent rumors, or at least it has already been disproven by Tesla's China team, saying that it's fake news. But there is also some chatters around saying that, Tesla might be bringing down the production numbers in their Chinese factories. Before moving over to Tesla, I think I just wanted to comment a little bit about Apple as well. So I've also been scrolling around and Googling around, thinking about this whole deglobalization. I don't really like to use the term deglobalization because people like to say that, people are not working with China anymore. I think it's specifically only the US-China relationship. China is still very much happy to work with the rest of Asia and other partners. But I think it's just between US, China, it has been a little bit more problematic. But specifically on like iPhone production, right? I think I'll just quote a line from one of the media sources saying that Apple actually need 8 years to shift a mere 10% of their production capacity out of China. So just saying, out of current capacity, 10%, they need 8 years to move 10% of the production away. Currently, China contractors produce more than 90% of Apple's product, including around 98% of your iPhones. So even though you like to read a lot of all these headlines, right, saying that, they're going to decouple from China, Apple is going to move their production lines out of China, right? Just know that in the near term, by near term, I mean 3 to 5 years, it's not feasible for them to uproot their whole manufacturing capacity out. And also, don't just be led by the headline saying that this is the end of China and stuff like that. I think I just wanted to comment on that part. So maybe I pass over to Kelvin. What's your whole read of this Apple Tesla China relationship?
I think it's good that they try to at least try to move out of China lah. I think the whole reason they went in is because of cheap labor, cheap that. Obviously the risk is quite big, like as we can see from the whole Russia-Europe thing, where a country can take an entire continent hostage. So I guess like I'm sure that Elon has taken this into account also. So he will try to use a cheap way to scale it up. Then once they have money, they will start diversifying elsewhere. So I guess that's in their plan.
Will you be concerned that margins start going down? Because I think other than cheap, right, there's also an argument, I think I read it somewhere, that there is a reason. I mean, Apple is also not a stupid company. Like the management of Apple is not dumb. They are critically aware of the risk that China poses, but they still decide to build a lot of their manufacturing capabilities there. I think one reason also is because they say, in US you have people that riot, that union, and cannot use riot. They unionize and they try to go against the establishments. While in China, on the other hand, you just give them a little bit more money, they'll OT and they'll be very efficient. They don't talk on the job and stuff like that. So these are the, how do I put it? These are the inefficiencies and the externalities that come out. So if they shift it over to elsewhere, I'm not saying that other countries are not good, but I'm just thinking from that perspective, that do you think margins will be affected and the whole chain itself? Because since everything is in China, they send each other is easy, but if you move the supply outwards, then you need to incur this kind of cost of moving and stuff.
For me, I've already factored in like a bear case scenario for Tesla, like lower demand. I gave a 20% discount rate, everyone not happy. But I'm already factoring all these bad news into it. So even if it goes down, I'm already prepared for it. And yeah, so to me, it's not a big factor. What about Eric? Eric, the Tesla bull.
Okay, Tesla investor, not very sure whether I will reject all the negative stuff. I try to think about it, like what's the probability. But the thing about what Chiking said, right, about Apple being smart, Tesla being smart. I think they have, as the management, they have also considered the logistic capabilities, the raw materials availability, the technical expertise of the people. So all these things like the manpower and all that, and the culture, like what Chiking has shared, everything is very pro-business. So like there's a reason why China is the manufacturer of the world. Like if you want to move it to some other place, yeah, sure. But do you have the people with the expertise to operate those machineries? Do you have the efficiency? Do you have the culture? Do you have the raw material? Because even if you ship it out of China, right, 90% of the rare metals, I think, are processed through China. So you still got to ship it out from China. So you incur additional costs if you try to shift too many things out of China. So I think that's why I think Elon is trying to go up the supply chain, right, to go into mining. So to bring the mining back to US. I don't know how long it will take. I think my estimate is at least it will take 5 to 8 years for those mines to become operational. I'm not even talking about ramping up to like a high production. Just to be operational, mines will take like 5 to 8 years. And you got to apply for all the permits and everything. So it will take a long time for people to shift production out of China. And that's just the manufacturing part. Yeah, not talking about the culture yet. I think I saw this tweet, right? On Twitter, they were saying that Elon is making the Twitter employees sleep at their place, and then they were making a big hoo-ha, like they say, "Oh, you make your employee who want to sleep at the place, then you indirectly or directly like forcing them to sleep overnight." But there in China, right, they eat, shit, sleep. They have like 3 shifts, like 24 hours. They're just churning out cars. As long as you pay them well, they're like, "What we love Elon." Right? US, you give them a bed, then it's like, "Why you give me bed? Why? Tell me why you give me. I don't want to sleep here." Like, I don't know. I think that's what they call the woke mentality, right? Like wow, everything is a social injustice, So I don't know. I think China is a great place if you want to do manufacturing of any sorts. Yeah. So that's my take. I do agree.
Yeah. I agree with you on the one that you say it's not just about the price now, because if you go back to, let's say, 10, 15 years ago, that's true. When China is like less developed 10, 20 years ago, yes, the only thing that they can provide is like, okay, cheap labor. But as of now, actually, if you compare the labor cost of China versus other regions, actually Chinese labor is not cheap anymore. But still, people don't want to get out from there because a lot of things that Eric just mentioned, like the skill labor, the infrastructure that provided by the government, all the support provided by the government, all these things actually is like a big ecosystem that is happening in China that helping all these business manufacture at scale and manufacture cheaply. I think this is something that many businesses cannot just walk away, because imagine that they walk away from China and replicate the whole things. Probably the price of iPhone need to double in order to produce the same thing. So I think that's why it's very, very hard. And I also don't think that from US perspective, it is their goal to actually untangle from China and then just try to hurt China in any way, because from business perspective, definitely make more sense to continue to expand on China. They actually wanted to continue this. It's just that they need a big backup plan, right? So for example, like we used to talk about, at least I used to talk a lot about semiconductor. A lot of reliance on TSMC also. All this, if you try to understand the semiconductor industry in Taiwan, you notice that actually there's a lot of dependency on the entire ecosystem, and it's very hard to walk away. They can set up something outside, but it's only like producing, let's say 5 to 10%, and this one also take years to produce. So I think that's the current situations now. And I think all this, if they force themselves to get out from China or in semiconductor case, get out from Taiwan, is really bad for margin. But this is something that is needed just to help them reduce the risk. Basically, diversify away from too much dependency on China. So I think a lot of consideration in there.
But I think I just wanted to add, right? Like if it's a 5-10% diversification, is it really material in that case though?
5-10% as a start. So if they can do it, they of course want to do it, like bring it further, like at least to 10, 20, 30%. But they have to start it somewhere because it is not easy. Like, for example, in China, let's say if we're talking about Apple, Foxconn, right? Their employees is not like 10,000 employees there, it's 100,000s of people there. Or only that city, the Foxconn city, have this kind of scale to produce whatever that Apple demands on an annual basis. So I think it's hard also because this entire city is not built in one day. The skilled labor doesn't become skilled workers in 2 years of training. It's not like that. It's actually started from like maybe first few version of iPhones. They already built this entire thing, the entire ecosystem together between Apple and also the people in China. So they help them build together. This is like we help each other and then we build this thing up, right? So it's not so easy to replicate. And this one really takes decades to build because you are not building a company. You're actually building the entire ecosystem. And it's very hard to replicate an ecosystem because all this actually take years to develop. Yeah.
I think, at least for myself, how I read the whole thing, it feels a lot more posturing and it's like negotiation on a very high level for the two leaders of both countries. But I mean, it's going a little bit into the politics really. But I personally think that at least in the, like I said, the short term, my short term means 3 to 5 years, right? It's not going to be anything substantial. They can pave the way to try to diversify, but if touch wood, now really touch wood, if something really happens, good luck to all of us.
Oh, I have a narrative to add. So someone
you want to draw a graph?
No,
don't need graph. Okay.
So I think the whole US versus China thing was because China was growing very fast. Like it was overtaking countries. Like from 10 years ago, China wasn't even in the top 2. Then now it's already in the top 2, overtook Japan and all the other countries. US is trying to prevent China from overtaking them. So it's trying to paint the whole picture that, oh, China is evil, we have to diversify out of China. That kind of shit. So I think like China actually wants to cooperate with all the countries. Aside from all the taking hostage stuff, I think it's good business to work with other countries. So I don't think China will also want to sabotage itself. Like the whole reason China allows Apple to continue being in China while excluding like all the other stuff like Google, Twitter, the rest, because I think like Apple is producing stuff in China, and that benefits China's economy. So I think China will still be there, but US I more or less still needs China in a way.
Totally agree. But just to add a small point, I think specifically on a few companies that they quote unquote ban, right? It's more so because of the media, the influence that they have. So if you really look into it, right? Apple's not banned. So you have companies like Starbucks, Walmart, Tesla inside, because these they can't really do anything to their population. But people like Google, Facebook, Twitter, all this, they can censor, they can don't listen to the government, they can don't censor and stuff like that. So that's why now the whole it's more of like those very internet-based, very media-based, and it's not that then it's kind of banned. But if not, I think for manufacturing capabilities wise, it's a competitive advantage of China. That where do you think Amazon get all their products from? Bunti, Alibaba. Okay. I think with that, I hope you guys enjoyed the discussion for this episode. We'll see you in the next one. And I promise you the next one will be pretty spicy. So hope you guys enjoyed. I'll see you in the next video. Bye-bye.